Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Julie Hyman. Let's get to the three things you need to know today. Markets are taking a breather this morning after a big rally on Thursday. All of the major indices, the Dow, NASDAQ, S&P 500, and now the Russell 2000 closed at all-time highs. The small cap index had not closed at a new record since 2021. It was a highly charged week on Wall Street after the Federal Reserve cut interest rates for the first time this year. Plus, trade tensions with China running hot. President Trump reportedly speaking now with Chinese President Xi Jinping as they look to close out a deal on TikTok and make progress on a broader trade deal. And a surprise earnings beat from FedEx. The results provided some relief to investors as tariff uncertainty has hammered the stock this year. Shares had been sharply higher on the news last night, but they're paring gains heading into the opening bell. The company also reinstated its full-year guidance. The shipping giant now expects to take a $1 billion hit from trade volatility, and the midpoint of its profit outlook did come in shy of estimates. Let's get a check-in on stock futures here this morning. We are seeing modest indications for modest gains at the open here this morning. So a little bit of extension of those records yesterday, but we could get some volatility today. We'll talk about that in a moment. So we'll see how the day plays out. Let's dig into our top stories of the day. Futures little changed after stocks rallied to fresh all-time highs. Plus, President Trump and Chinese President Xi Jinping speaking this morning on the future of U.S.-China relations, and fresh inflation data on deck, what that means for the Fed's path forward. Joining me now, senior reporter Brooke DePalma live at the NASDAQ, Morning Brief Market Sunrise host Ramzan Karmali live from our London studios, and Federal Reserve correspondent Jennifer Schonberger this morning. Ramzan, I'm going to start with you. Reportedly, we know that Trump and Xi are now speaking on the phone. There is a lot on the table here for them to discuss.
That's an understatement, Julie. I think it's fair to say that global markets really are bracing themselves for what could be a pretty critical call between Presidents Trump and Xi, which is currently happening right now, actually. Now, in China, in Hong Kong, the stock market was flat. Europe, the stock markets haven't really done very much. And that's partly, you'd expect after a massive Wall Street rally that we saw yesterday, which saw stocks finish at record highs, that would spill over to the rest of the world, and it really didn't. And I think it's because of nervousness over these talks between Trump and Xi. Now, President Trump, on his flight back from the UK, said that a deal over the future of TikTok in the US is all but done, and that he wants to make more progress on tariffs. And to be fair, the Chinese State news wires didn't to contradict him, just said a framework was in place. Now, Trump has, credited TikTok with helping him win another term as president, and Washington has extended a deadline several times for that app to be spun off from its Chinese parent company, ByteDance. But it looks like now that Oracle will lead a consortium to run the US arm of TikTok. So there's progress there, and that's quite important for deals to progress. Now, on the flip side, it's been a pretty rough week for Nvidia in China because the Chinese have accused the chipmaker of violating anti-monopoly laws, and then it told its big tech firms to pretty much stop buying Nvidia chips, AI chips. Now, we also heard news from Google as well this week. There was an antitrust probe into Google about the use of Android systems on mobile phones, and that's been dropped. Now, you might see that as a bit of a win, but earlier on Market Sunrise, I spoke to an economist out in Hong Kong and said, well, Google doesn't really have that much of a presence in China compared to it has in the US and other countries around the world. So perhaps we shouldn't read too much into that. So the focus really is on Nvidia and chips. There's another thing that China might be using for leverage is agriculture, because for the first time since at least the 90s, China hasn't bought any US soybeans at the start of the export season. So that could be a signal that Beijing wants to use agriculture in this trade fight with Washington. And look, we've had 4 rounds of trade talks between May and September between the US and Chinese officials, and there'll be probably more coming up in the coming weeks. And both sides though have backed off those really, really strict export controls. Remember, we had export controls of over 100%. Well, now we're seeing them down, for Chinese exports 30% and for US goods 10%. But that's only while they're in a pause situation. There's a 90-day pause, as you know, and that's set to expire in November. And if there's no deal, we could be returning to those triple-digit tariffs. So it's worth being wary of that. And this call really does need to go well. One of the other things that the president could bring up on his call with his Chinese counterpart is the issue of oil. We all know that he's particularly unhappy that China, as well as India, continues to buy Russian oil.
A lot, as you said, on the table there. And the backdrop here in the U.S. is that stocks are at record highs, Brooke.
Good morning, Julie. That's absolutely right. We hit record highs yet again on Thursday afternoon. And now as we make our way into today's trading session, we are seeing all three major indices edge just a bit higher as those trade talks get underway. In addition to that, what really boosted momentum this week was that quarter-point cut from the Federal Reserve and that hint that more cuts are yet to come later on this year. And that really has been bullish for stock, this expectation that the Federal Reserve will begin easing as we make our way into the rest of the year. The S&P 500 up about 3% so far this month, in what typically is a quieter month for the stock market. And that really also has been pushed higher by these companies continuing to beat out earnings expectations from the street. But if you take a step back as well, really all eyes still remain on that key jobs report, and more inflation data is still yet to come.
As we consider all of this, we of course have to talk about with the inflation data, what the Fed is going to be doing. There's a new piece out from Neel Kashkari here this morning that's getting a lot of attention, Jen.
Good morning, Julia. That's right. Minneapolis Fed President Neel Kashkari out with a new essay this morning in which he says he's more concerned about the jobs market of the Fed's dual mandate rather than sticky inflation. And as a result, he actually upped the number of rate cuts he sees this year for a total of 3. That's up from 2, which is what he penciled in back in June. Kashkari writing in that essay, quote, "I believe the risk of a sharp increase in unemployment warrants the committee taking some action to support the labor market," though he added the caveat that the Fed is not on a preset course for a series of rate cuts. And if the labor market were to become resilient, re-strengthen, then perhaps the Fed could hit the pause button on any further rate cuts, or if warranted, even hike rates. Now, when it comes to the inflation side of the Fed's dual mandate, he said that there's going to be uncertainty he expects around the impact of tariffs on inflation for the next year or two, but that he doesn't expect inflation to pop much above 3%. He doesn't see it coming to 4 or 5%. And for that reason, he feels okay to be focused more on the job side of the dual mandate. Though he did also say that he is monitoring inflation expectations and noted that any threat to central bank independence could cause that to wobble.
So while that's sort of the macro view, there's one company that we know is really sort of embroiled in the tariff situation, and that's FedEx. And Brooke, we just heard from that company last night, and they gave us more of a quantification of the effect of tariffs on the company.
Yeah, they absolutely did. They did beat on both the top and bottom line, as you can see right here on your screen. And that's really what's leading the momentum here, up about 2% in the pre-market. But the company did warn about the impact that they've seen, specifically because of the U.S. and China trade tension that's currently underway. They said that the company incurred a $150 million in headwinds from the global trade environment. They said the majority of that is the de minimis impacted in coming out of the China lane from the China market. They said they anticipate that to continue to flow through the rest of the year. Now, they went on to say that their profit, their adjusted operating income offsets to include, that's expected a $1 billion headwind because of the current trade environment going on. They said that they recognize that this number could be in flex as the direction of these trade tensions continue. But what is surprising and why you're seeing this stock move higher this morning is that they did do well despite all this noise that they've been up against, particularly the domestic market here in the U.S. outperformed the international market. The CEO saying on the call yesterday afternoon that they delivered a solid quarter in line with the Q1 outlook that they shared back in June, despite significant volatility and uncertainty around that global trade environment. And so certainly, as you can see here, this has been a company that has really been under pressure, down nearly 20% year to date, as investors try to understand how exactly they're planning to offset all this volatility within the market.
And back to the macro picture, we're going to get more information on the inflation picture next week, Jen, when we get PCE, which, as we always say, is the preferred inflation measure of the Federal Reserve.
Yeah, that's right. And I'm not expecting any major surprises there, Julie. The estimate is for 2.9% on core PCE, so that excludes those volatile food and energy prices. And we kind of knew this even back in August because we know that we use data from the CPI index and the PPI index to get to the PCE. And so Fed Chair Jay Powell even mentioned that stat in his speech back in Jackson Hole at the end of August. So unless that comes in hotter than expected, I don't expect that that's going to change the calculus much for the Fed here. We got new economic projections this week with the Fed decision, and they are expecting core PCE to end the year at 3.1%. So still some room to maneuver upwards there, even if we got a hotter print than 2.9%. But 2.9 would also be holding the same level as the month prior. So again, don't think that changes the calculus. We're really focused on the job market here, and I think it's that next jobs report due out on October 3rd that is going to be the focal point.
And then finally today, something that we have been talking to a lot of investors and CEOs about this week is President Trump's proposal that the SEC change the rules about when they have to report, perhaps going to a twice annual system instead of the quarterly system. I want to play for you a little bit of what these folks had to say.
It's not a bad way to kind of incentivize long-term thinking rather than just a quarterly outlook.
I'd be okay either way. I do like the opportunity to talk to investors every quarter about the business and the future and the vision of what we're trying to do. But I do think sometimes the industry gets too obsessed with the quarterly numbers and infers too much forward guidance and forward momentum or lack thereof from a single quarter.
Sometimes I think when you're in a really volatile backdrop, you do want to be laying some of that groundwork quarterly. For me, that's less about the forecast and more just about providing color, just like what we're talking about the business. Yeah. That being said, I think we're all trying to find ways to free up capacity and make sure we're spending capacity in the most value-added areas.
So, people certainly seem open to it. And Brooke, we have some developments on this morning.
Yeah, certainly. We did have Paul Atkins, he's chairman of the SEC, tell CNBC this morning that the agency will propose a rule change, that they'll consider that and move forward from there. He also noted that foreign private issuers do report on a semi-annual basis. Of course, here in the U.S., status quo is 4 times a year. And so definitely wait and see, should this get approved, if this is different or changed in the coming years. But as you can see right there, as I spoke to Best Buy CEO, there are some puts and takes on whether or not executives would like that only reporting twice a year, especially in this volatile backdrop.
Well, and even if they can report twice a year, certainly there will be companies that opt to report more frequently. It just will be that they are not required to. So it will be very interesting to see how it plays out. Thanks so much, guys. Brooke, Ramzan, and Jennifer. Coming up, we'll have more on today's top trending tickers and get a check-in on shares of Netscope following that company's IPO. Don't go anywhere. You're watching Morning Brief on Yahoo Finance. Now time for some of today's top trending tickers. We are watching FedEx, Klaviyo, and Netscope. First up, we have FedEx. The company beat on the top and bottom lines in its latest earnings report. Still, it's warning of $1 billion impact from President Trump's trade war. FedEx's CEO says that despite significant volatility and trade headwinds, the results highlight the company's resilience. FedEx said the majority of its hurdles in the first quarter were due to the loss of the de minimis exemption. The courier had previously withheld a full-year outlook, citing an inability to predict how how demand would be shaped by Trump's tariff policies. Its forecast assumes no further negative developments in global trade dynamics. This shares were up more sharply after the results, now only gaining less than 1%. Next up, Klaviyo, the e-marketing company, getting an upgrade over at Morgan Stanley. Analysts at the firm raising it to overweight from equal weight. They cite an attractive entry point and positive growth outlook. Analyst Elizabeth Porter says, also adding that the stock is trading on a discount to peers and that conservative earnings forecasts position the firm for estimate revisions. And finally, Netscope. Shares extending gains after the cybersecurity firm jumped 18% in its trading debut yesterday. Netscope's IPO drew demand for more than 23 times the available shares, according to Bloomberg. CEO Sanjay Berry says the strong demand reflects how the company is modernizing both networking and security for the cloud and AI era. Netscope raised $908 million in its IPO. Its market value now around $8 billion. You can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. The Russell 2000 hitting a record high this week as hopes for future rate cuts boost small caps. My next guest says all signs point to the outperformance continuing. Joining me now, Lou Basenese, Prairie Operating Company's Executive Vice President of Market Strategy and thebigskinny.com founder. Lou, also we should mention the Russell 2000 hitting a record high for the first time since 2021. So
forever.
Finally joining
Yes.
the other averages, large caps, in their records. As you reminded me ahead of today, you have been on the small cap train for a little while. Maybe you were a little early.
Definitely
but
early.
The train is finally pulling into the station.
Yes.
So what happens now?
Listen, I think I was early. It was still performing, just underperforming large caps. I think two structural things have shifted right now. You've now rejoined the rest of the indexes and getting to this point where you're outperforming, hitting new all-time highs. That was a technical resistance. But now you're lowering interest rates. So this is helping these companies that 40% of them are unprofitable, which means they're financing their businesses with cash, a lot of debt. It makes it more affordable. And we've just structurally been overdue for a small cap outperformance. I mean, it's been since coming off the COVID bottoms that that's when small caps and micro caps outperform. But I think one other thing that's really important, because that's the technicals and kind of historical trends, is the fundamentals. Small cap earnings growth are expected to flip from being negative this year to positive 18% growth next year and positive 37% growth in 2027. Now, those are estimates. Mm-hmm. We know how estimates go, right? They can come down easily. But that should be the fundamental driver, because small caps are trading at a forward PE of about 15 versus 22 and change for S&P and 30 plus for Mag 7. So fundamentally compelling, momentum's compelling. I think it's finally time where I can, I don't want to take a victory lap by any means, because I've been here before.
Yes. So humility is important in these markets. I did a little homework. I gave myself a little homework because I was curious. I went back and said, okay, what has happened with small caps versus large caps over the long term? So I looked at 5 years, I looked at 10 years, I looked at 20 years, I looked at 30 years, I looked at 40 years. And so here we have the relative returns. The S&P 500 has beat the Russell consistently over those
So we're going back for, I mean, if
40 years, and by the way, if you look at it on a total return basis, it's still an outperformance, although the gap changes. Yeah. But doesn't it pay over the longer term to just stay in those large caps?
It does, but then you see periods of strong outperformance, right? So
if you're trading more actively,
yes, I guess
that's the big difference.
I think about asset allocation, what is it, and then tactical allocation, where you have your core basis, and then you say, hey, small caps have underperformed now for 11 to 12 years. They usually go in 7-year cycles with large caps. So now we're setting up for another cycle of outperformance, and it's how do you leverage that to your benefit? It's not rotate out of large caps entirely, go into small caps and try and play that game, because it's a fool's errand. No one can market time like that. But I do think you have to be situational, opportunistic, just like you would have been earlier in the year in European stocks that were trading at like 9 to 10 times earnings. And now that's emerging market stocks. So it's more of this tactical rotation and moving money around. Rebalance out of large caps that have done well, put that money to work in small caps that were undervalued.
Fair. Yeah. Okay, let's talk about another area that you think people should be getting into now, and that's energy, which is more sort of your bread and butter of what you're doing.
It is, yes, on a
in your day job.
Yes.
So what is making oil and oil stocks attractive?
So the president would love to say drill baby drill and just have it magically work to bring on supplies and pull down prices. The problem is you have a structural disadvantage in the US. We've hit peak production. The way that shale production declines 30 to 50% year over year means we have to do so much drilling just to keep at that current 13.5 million barrels a year. Now the IEA is coming out too now and realizing if we don't do more drilling, Globally, we're going to see a $5.5 million barrel a day equivalent decline in supplies. That's about 5 to 6%. So right now you're setting up in a world where we know there's runaway demand for AI and electricity. 60% electricity generation still comes from fossil fuels. So if you have diminishing supplies, increasing demand, that leads to one conclusion: the price is going to go up. And now you're seeing insiders start to buy in the industry. It's happening at our company as well, some board of directors, so that's always a fundamental indicator. The allocation is really underweighted in the S&P too. So even if institutions allocate an extra 1%, right now it's about a 3.5% weight in the S&P. So a little bit would change the direction and trajectory of these companies and their stocks very quickly.
If I'm thinking about the AI angle in particular and where that power generation is coming from, should I be biased a little more towards gas over oil? Because gas is just a huge.
Gas is the bridge.
Yeah,
gas is the bridge to nuclear and then reliable solar, right? I think the problem with solar and data centers is you have to have 99.9999%, so even to the 6th log, uptime guaranteed, and you can't get that with solar. It's not.
You need the mix.
You need the mix, exactly. So I think gas is the natural fast path to get to supplying this extra demand that we're going to need, so electricity. I think right now AI is consuming about 7 gigawatt hours. We need to go to 82 in the next 5 years. So that's a lot of additional electricity generation. We can't just flip a switch, unfortunately, right? You got to build the infrastructure, the transmission lines, the power plants. Easier said than done. So I think this is what bodes well for the oil and gas space that has really been in a capital discipline mode for the last 7 or 8 years after the last boom. Let's just pay down debt, unlever, pay cash back to shareholders. I think you're going to pivot into higher prices as they come up. It makes it more profitable to drill, continue to expand on the wells. And I will say this, from an environmental side, we've gotten much better at doing much cleaner. Technological innovation really helps keep emissions under control. So you're seeing that in refinery process technology, you're seeing it in the fracturing technology. So again, I don't want to think because I'm a fossil fuel person, I'm anti everything else. You said it earlier, it's all of the above. We need a balanced mix and continued innovation to make this cleaner, sustainable, and then provide enough supplies.
And I also want to get to some specific picks.
Yeah.
And it's interesting, one of them that you brought to us is neither a small cap nor an oil and gas stock, but it's an interesting one, and that's Alphabet, right? Which, we've seen the company move past the court ruling here. And the stock has been ripping higher.
Yeah, if you haven't figured out, I'm a bit of a contrarian, right? So I was early on Alphabet because I just thought that regulatory risk was overblown, and now we're seeing its valuation catch up, but it's still got a ways to go. I mean, when we were talking about it last time, it was about 17, 18 times forward earnings. We're at 24 times. We could still get to 30 if the AI trend really develops for Alphabet, and I think that's what we're seeing based on the last results. Everyone said AI was going to kill search, and then Alphabet came up and put up results that said, nope, hold on, we're not done yet. I don't think it goes into a decline like everyone was worried about with Intel or is now worrying about with Apple. I think this is the resurgence of search and Google's dominance in that.
Interesting.
So we'll see. I think it can go higher from here.
We'll see. We'll see if this contrarian pick works out. Thanks so much, Lou. Great to see you. That does it for Morning Brief. Opening bid next on Yahoo Finance. Don't go anywhere.